purpose of this video is to help Year 12 accounting students know and understand how to analyse inventory turnover, one of our key indicators of performance to be analysed in the Year 12 accounting course. So what is inventory turnover? Inventory turnover measures the average number of days it takes for a business to sell its inventory or convert it to sales. So you can see here we've got our formula. Now remember that with the Year 12 accounting course, you're not required to memorise the formula or calculate things like inventory turnover. However, you are expected to be able to analyse it. So it is important to understand what is actually used to calculate inventory turnover, so then you can understand what sort of things may need to change in order to improve the performance of the business. Generally, the faster the inventory turnover, the quicker the inventory is being sold by the business. And this enhances the business's ability to earn profit and to potentially generate cash from their inventory. So when we're analysing inventory turnover, it's important to compare to different benchmarks. And this is similar to any other sort of financial indicator where we look at different kinds of performance and compare it to something else. So 3 common examples would be things like measuring the performance against previous periods, maybe the same time last month or the same time 12 months ago. You could also measure against expected or budgeted performance. Or you could be looking for the performance of your competitors or the industry through something like the industry average. Now, if we do this comparison, we're looking to see if our inventory turnover is faster or slower than the benchmarks. And so when we look at this, we can see there are some benefits and some negatives of having things like a fast or slow inventory turnover. If we have a fast inventory turnover compared to those benchmarks, some of the positives could be beneficial in terms of profit, in terms of liquidity, because this may indicate higher sales or it may indicate a better ability to generate cash from sales, which we can then use to meet our debts. It could also indicate a reduced chance or risk of inventory loss or write-down. And the reason why is that inventory is moving quicker through our business. Therefore, there's less time for it to potentially get damaged before we sell it. However, the downsides of having a fast inventory turnover is that it could actually be too fast. And that might indicate that we haven't quite got things right with our selling price, meaning we might be setting it too low. It also could mean that we might be keeping low levels of inventory on hand. And for those people that might do business management, something like a just-in-time system might actually lead to things like increased delivery costs, or we might lose the benefit of buying large amounts of inventory in bulk. But looking at the other side, what are some of the benefits or the pros and cons of having a slow inventory turnover? Well, a slow inventory turnover might not be a bad thing. It depends on the kinds of inventory you've got. If you're dealing with items that are high value or maybe rare, it could be expected that there is a slow inventory turnover for that product. An example might be if you're dealing in something like vintage cars. It might take a really long time to sell one car. However, there's mostly downsides to this. And a slow inventory turnover could be caused by decreasing or low sales, could indicate some profitability issues. This might cause liquidity issues if we're not generating enough cash from our sales of inventory. And it could lead to high management costs. So if we have a slow inventory turnover, it might be due to the high levels of inventory on hand that we're keeping. And when we keep high levels of inventory on hand, this might cost us more in terms of storage, or it could increase the risk of inventory loss through things like damage or theft, or the need to write things down because they go out of fashion or become obsolete. So let's look at an example of how to analyse inventory turnover. We've got here the same indicator of inventory turnover, and we've got it for 3 years. So we've got 2019, 2018 and 2017. We also have an industry average. So we've actually got 2 different kinds of benchmarks here that we can use to compare our performance. We can compare against the industry average, and we can compare with different periods for the same business. So for example, the first thing that you want to look at is breaking down this question. So to analyse is to break apart and discuss or talk about all the different pieces that go into this question. So looking at this question here, analyse the inventory turnover for Terry's TVs, considering the impact on performance with regards to profit. So straight away we can see there are multiple parts to this question that need to be responded to. And so some questions that you may want to consider to ensure you have a full, really good quality response would be these ones here. What is the pattern or trend? How does this compare to benchmarks? Is it satisfactory or not? What does this tell us about performance? And how does this impact profit? So you can see those 4 sort of sub-questions are helping to answer that overall analysis. So something you might want to try now is pausing the video, having a go at writing this, and then I'm going to break down this question in a bit more depth. So let's have a look at these 4 sub-questions. First question, what pattern or trend is there in the ITO, or the inventory turnover? So I need to have a look at what's been happening over time, and then potentially how that compares to things like benchmarks for the second part. So I'm going to have a look for a trend, and I can see that between 2017 and 2018 there was an increase of 2 days, and between 2018 and 2019 there was an increase of 6 days. So straight away I can see that it's taking us longer to be converting our inventory to sales. So the kinds of language that we're going to use when we're talking about the pattern or the trend is things like faster or slower, or could be more time, less time. So in this case, our inventory turnover is becoming slower because it's taking more time or longer to be able to convert that inventory to sales. So we can see that it's slowing down, and thinking about our table from over here before, we know that a slow inventory turnover could indicate some problems. So then let's compare that to the benchmark. So we can compare to the previous period, and we've done that a little bit by saying that it's slower and it's taking longer, but we can also compare to the industry average, which in this case is 50 days. So when we have a look at our 2019 data, our most recent data, you can see that we're at 54 days. So even though the pattern was that the inventory turnover was slowing and taking us longer, you can see that in 2017 and 2018 it was still better than the industry average. However, in 2019 it's now gone above industry average. So not only is it slowing, and it's gone above the average, so it's slower than our competitors. So this would potentially indicate that it's not satisfactory. So what does this tell us about performance? This is where we would go back and we would talk about some of the issues that are presented in this table here. And so we might talk about reasons why it could potentially be slowing down and what impact that might have on the business's performance. So we might talk about things like profitability, liquidity, and it could be talking about high levels of costs to manage that inventory. This is then going to lead us to the talk about profit. So when we're talking about profit, we need to think about what revenues and expenses have changed. So with a question on inventory turnover, there's lots to talk about here. You could talk about sales, you could talk about cost of goods sold, you could talk about things like loss or write down. Each of these are going to impact on profit. You could even talk about things like buying expenses or storage expenses, lots to talk about. But essentially you want to make a decision about what's going to happen to profit. Is it going to go up or down? Okay, is it going to have a positive effect or a negative effect? And these are the sorts of things you want to talk about when you're analysing inventory turnover. So now would be a good time to pause the video and then have a go at writing a response for yourself. What we'll then do is we'll show you a model and we'll unpack that model a little bit to then show you the kinds of things that you may want to include in your written response. So here we have a model response for the question that we just looked at. And you can see that it includes those 4 sub-questions. So this first little paragraph here is all about question 1 and 2. What's the trend? How does it compare to the benchmark? What does this mean? Is this good or bad? Is it satisfactory or unsatisfactory? So you can see I've been using particular language. Things like slowing over time, taking longer. And you'll notice that I've actually worked in the definition of ITO here. I'm telling them, what does this actually mean? And that's really important because it shows the assessor that you know what this indicator measures. I'm then comparing it to the benchmark. And you can see that I'm using that language faster, slower. I'm talking about particular days as well, using really specific information. And then I'm making a judgment call. Is it satisfactory or not satisfactory? The second paragraph here is all about question 3. It can indicate poor performance. So if I have a look and think about that question, I know that this is saying, what does this mean for performance? So I'm saying it could indicate poor performance, could have a negative impact on profitability, which is one area of performance. I'm then explaining why, and you can tell because I'm using that sentence starter of this is because, or the reason why is. And I'm giving reasons why the ITO might be slowing down. It could be because of decreased low sales. And then I'm making a connection to low profits or poor performance. The last part here is making a really specific link to things like profit. So you can see here I've talked about the idea of a negative impact on profit. And I've talked about the increased costs of inventory management. And if I really wanted to strengthen this even further, I'd probably want to see the use of language such as revenue and expense. So even right now, rereading this, I can see that there's some changes even I might want to make to this model to really strengthen it, to make it a really strong analysis here. So this can be used as a bit of a model of how to analyse, and the same sort of process can be used for other turnover measurements such as accounts receivable turnover or accounts payable turnover. Now there is a further video on analysing inventory turnover that goes to the next level, which is about how to connect the 3 different turnover measures together into a really deep analysis.